Joining us now on the phone line is Ryan Sweet, who's Director of Economics at Moody's Analytics. Good morning, Ryan. Thank you for joining us. This is Cheryl on the other side. Most of the economists now coming out and actually saying that if we are not already in the recession, we're definitely heading to one. And what's Moody's take on that?
So our official baseline, which we update the first week of every month, we don't have a recession penciled into the forecast yet, but we do view the risks of a downturn, either having already begun or is one that's we're barreling towards, are uncomfortably high. And the primary catalyst is the coronavirus, which has caused significant disruptions to business activity throughout the United States and globally. So I think we're going to need a lot of luck to skirt a recession.
When estimates were to grow about 2% and now the estimates are coming into 0.5 to about 1% for world growth, does that already mean recession, even if technically we are on the positive side?
Yeah, I mean, you can have a situation just like, for example, with China. I mean, China's in a growth recession. So, China's economy probably contracted in the first quarter. But you can have other countries where the economy typically isn't growing fast enough. So you're growing below your potential growth rate. Unemployment begins to rise. Inflation is decelerating. And that's a growth recession. So, at least in the U.S., we don't use the textbook definition of a technical recession, which is back-to-back quarters of declining GDP. The NBER, the National Bureau of Economic Research, who dates the business cycle in the U.S., uses a more vague definition, meaning that it has to be a prolonged period of economic weakness. And that's likely what we're in the midst of right now. So, I wouldn't be surprised if we don't adopt a recession as our baseline soon. We're just not to that point yet, because historically we want to be very, very confident that the economy is headed towards a recession before we change our forecast.
All right, Ryan. Also, what's your outlook for the global growth? What are you factoring in terms of how the global growth will be like for 2020? And also, do you see the repercussions of coronavirus to extend on to next year as well?
So we do expect global growth to be very weak this year, 1.5%, 2%. And, this could get revised lower if we, adopt a recession in the U.S. as our baseline. Countries like Italy are already in a recession. France will fall into a recession. So the number of countries that, are falling into recession are increasing, it seems like, by the week because of the coronavirus. So we do think, the global economy is going to really struggle this year. The key now is to assess, possibly what's the severity of the recession, what's the duration of the recession, and that's where the policy response is key. There's only so much the Federal Reserve can do, the ECB, the Bank of Japan. Central banks are, they have limited powers. What they're really focused on now is making sure credit markets globally are functioning. So they're providing as much liquidity to markets as possible. Now, the key really is fiscal policy, and the U.S. is kicking around the idea of $1 trillion stimulus. UK is providing funding for businesses. France is getting aggressive. So in Germany, for example, is doing fiscal stimulus. This will all help. It won't help. It's not going to cure the coronavirus. It could help cushion some of these global economies during this period of prolonged economic weakness. But on the other end, hopefully the fiscal stimulus combined with monetary support can get these economies back on their feet very, very quickly.
Right. Also, Ryan, when we just talk about the sort of sell-off you've seen across asset classes, what does this tell you? The price fall will also lead to a lot of damage rather than only, the news flow that you're getting around the economy?
Yeah, it will. I mean, take, for example, the U.S. The stock market decline, that's erased trillions of dollars worth of household wealth. And the impact of the wealth effect isn't linear, meaning that, when stock market's going up, the wealth effect's pretty small, a couple cents. But on the way down, when stock market's falling, the wealth effect is much larger. So people begin to panic. They see their 401ks declining in value. The baby boomers in the U.S. in particular, they're going to start pulling back very, very quickly on their spending, because they're checking the stock market every day. So the wealth effect is pretty potent on the way down. And that's going to contribute to a sharp decline in second quarter GDP. not only just do we have school closures, businesses are closing down. We're going to see some layoffs increase because businesses are cutting workers, they're cutting hours, everything to address the coronavirus. And so I do think the wealth effects from the stock market will contribute to a decline in second quarter GDP. Throw on top of that lower oil prices. That hurts the U.S. economy now. It's probably a net negative right now because we're not going to get a big boost to consumer spending because people are hunkered down. They're not going to go out and spend. And typically when we see oil prices and gasoline prices go down, they go to restaurants, movies, Broadway. That's not going to happen. And now with oil prices, we're going to see business investment drop, particularly anywhere from North Dakota all the way down to Texas.
Ryan, just a word as far as, what will be the first signs of improvement? Would you see that, all these talks of shutdown getting away would be the first signs of improvement, or the first signs of improvement will actually be when you start to get the reduction in number of people getting infected from virus?
Yeah, I think the first sign of improvement is when you start to see that curve flatten out and beginning to decline. And I mean, you see this in China. You see it in some other countries. So there's indications that, the actions that other countries are undertaking, what the U.S. is beginning to do, can help, flatten the curve, begin to reduce the number of cases. I think that would be the first indication. The concern I have is that, is this really altering people's behavior? Are people going to go back out and spend at restaurants as much as they did as before? Maybe telecommuting, working from home are going to become more popular. So there are some potential, medium and long-term implications from the coronavirus that I think economists are just starting to contemplate. Because right now we're worried about the public health issue and also trying to figure out the severity and the duration of this next possible recession that we're facing.
Right, we'll leave it at there, Ryan. Thank you for joining us, giving us a take on the world economy. Definitely going to suffer because of coronavirus and its impact. That's Ryan Sweet, who's Director of Economics at Moody's Analytics.